All right, welcome everybody. I think we'll go ahead and get started. If that works for everyone here. You got a chat from Katie there on, you can raise your hand to be unmuted and ask a question, or feel free to use the chat definitely at any time. But thanks to you all for joining. It's good to see some familiar names in the participant list, and good to see some new names too of folks that I didn't have the pleasure of having at UMKC. So a little background on me. I'm a finance professor at the Block School. This is my 9th year at UMKC. I came here from Florida State. It's my 13th year of teaching finance at the university level. And my research and teaching areas are mostly in corporate international finance, valuation, M&A, wide variety of topics. But lately, I've been talking about this topic a lot, which is kind of the economic impact of this recent crisis. So I'm going to talk a little bit about that generally. I also want to talk a little bit about how that impacts younger alumni and earlier career folks in particular. But before we get going, I wanted to kind of start off with this motto of mine, basically, which is if I can manage to set the bar low enough for your expectations, then I have a much higher chance of clearing it. So in this context, what that means is that I think we'd all like some clarity on what's going to happen in the economy and what's going to happen with this crisis, and to have some exact ideas. And I just want to set the bar very low on that I don't have any answers on that front. I think there are a lot of unknowns, and I have more questions myself than I have answers. But what I do think we can do is make use of a narrative, kind of a story of what's going on, and develop a story. I'll give you kind of my version, and then I'm anxious to hear from all of you what you're seeing and what you have questions on, and your own story of what's going on economically. And the idea is that although we're not going to maybe get any definitive answers, that we might have kind of a reference point that can help us make decisions, can maybe help us make some changes and lead and plan and keep moving forward. So that's really the goal of where we're headed here. Again, if you have any questions about anything at any time, feel free to interrupt via chat or raise your hand. It's not an interruption at all. It's works perfect. I'm going to leave some time at the end. I've got some discussion questions that I'd love to hear from you all on, and then also kind of open it up for any questions that you have. But I'm also going to make use of some polls, and so we're going to do our first poll to get us going here. I just want to get a sense of where this group is at right now on kind of how you are thinking about the market currently. I'll just be quiet and give you a chance to respond here and think. All right, I'll give you a last call here to vote, and then I'm going to close this off, and I'll share the results so you can see where folks are at. All right, we got almost everybody here. So the holds have it by just a bit, but buy and hold have it 0 in the sell category. So no one panicking looking at the market anyway and feeling like they want out. I've done this poll with different groups, and the proportion of sell has been a little bit higher, but the groups I've been working with are a less young alumni, shall we say, than this group. And so I think it's, obviously a good indicator early on that this group seems to realize that one of the perks of being a young alumni and early in the career is you have time to wait out these dips and crises. So very interesting, and I appreciate your feedback on that. So let me move back to this idea of narrative that I'm going to be talking about. And narrative has become kind of a popular buzzword of sorts, but of course we're just talking about stories. But narratives are the way that I like to make sense of what's going on in the economy, and I think there's a lot of appeal. And I just want to talk a little bit about why I think this is an interesting tool to have access to. So the first example I have is if I ask you to think about a cow and imagine a cow, probably something very much like this comes to mind, almost immediately and instinctively. You have a very concrete idea of what a cow is. If I ask you about something like economic stimulus and ask you to picture that, probably nothing quite so clear as an image of a cow comes to mind. Maybe some words come to mind, maybe some images come to mind, maybe questions come to mind, but it's a more abstract concept. And so the point of using narratives is to help us take more abstract ideas and make them a little more concrete by thinking about them in terms of a story. So this is pretty natural, obviously. The mind likes stories. The mind likes to think this way. We tell ourselves stories, we tell other people's stories, we repeat stories. Certainly, many of you from family and friends can relate to this. We always spot it in other people of, yeah, I've heard that story a million times kind of thing. But we tell ourselves many stories because it helps us kind of shortcut facts, and it helps us convey sort of a meaning that goes beyond just kind of the simple text of our stories. And so I'm a fan of narrative, and we're going to talk a lot about this. But of course, one of the risks of a narrative in storytelling is stories don't have to be true. And there's some risk to moving forward as if a story were true, when in fact it's really not. And maybe this is because we lack information. Maybe we've been deceived, maybe we've self-deceived. But needless to say, there is some risk to relying too heavily on narratives. And so just, briefly, I didn't come up with this idea. This is not my invention, this concept of narrative and numbers. Robert Shiller won the Nobel Prize some years ago, and he has a book out called Narrative Economics, exactly the title of this slide. And so that's worth a read, but he's been talking about the importance of understanding narratives, and I'll give a couple of examples from his work later. And then Professor DeModer at NYU is one of my favorite thinkers. You should check out his blog. He writes a lot on what's going on in the market right now if you want to kind of a deep dive into the numbers. But the thing he adds to the narrative discussion is narrative and numbers. And you're going to see this is going to be the direction I'm going to move us today, which is it's great to have a story, but if we have a story that's unsupported with numbers, then we're vulnerable to untrue stories and narratives that cause us more harm than they do good. So that is the direction that we're going to head is getting a better sense of some numbers that we already know, some historical numbers that might help us, and then also some questions about what numbers should we be looking for. And the other thing that I'd add is if you think about kind of the role of leaders, especially in disruptive periods like we're in now, it's pretty easy to just read what's out there and get some idea of what a consensus opinion is. It's a much harder thing to create our own narrative. But if you look at folks that have been very successful leaders through difficult times, they've really excelled at bucking traditional narratives or really being the first to come up with what ends up being a consensus narrative. But basically they think for themselves. And they come to their own conclusions based on their own analysis. And so just to give you a sense of some narratives and also get your opinion on some narratives, I'm going to move to our next poll question. And you can select more than one answer here, but basically I've got 3 common economic narratives, and I want you to click the box on each of these if you disagree with a narrative. Or you can agree with all of the narratives listed here, and that would be checking the 4th box. But you could check anywhere between 1 and 3 boxes here. So I'll be quiet and let you read these. All right, maybe take about 10 more seconds to submit if you haven't. We'll take a look. All right. Perfect. So the least popular narrative is that housing prices can only go up. Only one person agreeing with this, almost everybody disagreeing with this. And of course, this is partly because of the 2008 financial crisis in which we saw housing prices decline. So just a couple things on this narrative. If I had done this presentation in 2006, before the housing crisis, I don't know exactly what this number would have been, but far more people agreed with that narrative. And not only just kind of average folks, but banks and regulators and folks in the housing sector basically operated as if at a minimum housing prices would remain flat, and probably that they would go up. That's part of that assumption, that narrative, the belief that that narrative reflected reality was one of the underlying causes of the financial crisis. And that's that Schiller book, Narrative Economics, I was talking about. That's one of the examples he points out, is the narrative made a lot of sense. The idea that housing prices can only go up. There's only so much land. There's the population is increasing, so demand for housing is probably going to go up, and the supply of land isn't really going to change. And so there was reason to think that land and housing prices are probably only ever going to go up. But we got a narrative busting moment. And what tends to be the case is then people really evaluate that narrative, but they don't take the opportunity to reevaluate other narratives that might be similarly challenging. So most people, the most popular narrative here is gold, that folks feel like gold is a pretty safe place to be when stocks go down. So I want to talk about that one, and then we're about split on whether or not these large market moves are pretty rare, black swan kind of extreme type of events. And this is really, I'm going to use the last two as examples of why I think putting some numbers to narratives is such an important thing to do. So the first is the narrative on gold and stocks. So gold in blue, the S&P in orange. And so this goes back, about 5 years. And the thing that I want to point out, really two things that I want to point out, is there's really different ways I could have phrased this narrative on stocks. And one idea is that in general, gold is less risky than stocks. And one is that when things go bad in stocks, gold is a good place to be. And so there's kind of two sides to that. One is kind of an overall story of gold provides some safety. And then there is this added narrative, which is usually included, which is when things go bad, then gold is really a good place to be. Well, what I'd point out, first of all, and of course, this is 5 years. If you looked at different windows, you could see different data. And this is going to sound like I'm anti-gold here. I'm not at all. I'm just trying to point out the data. Without running any statistics on this, clearly gold is more risky than stocks over this period, right? The up and down moves of gold are more extreme than that of the stocks. And we think of stocks as being kind of subject to a lot of volatility, which we usually think of as being risk. And so that really hasn't been true over this period. And then check out, March of this year when the stocks were tanking, gold also tanked. And the slope of those lines is so similar that about the only time that gold and stocks actually really closely track is right at the basically darkest moment in the market since the financial crisis. So this is not the only time that gold and stocks have moved together at bad periods for stocks. And so, whether or not gold really works as a hedge or a risk reducer to stocks, and whether or not gold is a good place to be when stocks are struggling, I don't think that narrative is obviously true. I don't think it's obviously false necessarily. Gold has gone up. So has the stock market. I mean, even as I'm typing here today, we have another day of green in stocks. So that's this narrative and some numbers there. The next one is on this narrative of, are these large moves in stocks pretty rare black swan type of events? Most people, the narrative usually says that they are pretty rare events. And some people are just kind of casual about why they think that's the case. Like maybe they don't really remember it happening very often, and so they don't think it's a super common thing. But a lot of people, even in finance classes, we often teach students and talk about how returns on stocks are roughly normal. And if this is starting to give you cold sweats seeing normal distributions and statistics, I apologize. We're not going to get into a heated statistical discussion here. But the kind of the back it out probabilities from a normal distribution would say that for daily returns, we would expect a return of about 4 standard deviations from the mean about every 50 years, so maybe once or twice a lifetime, and a 5 standard deviation change about every 7,000 years. So I'll be generous and give us 100-year lifespans and say, maybe every 70 lifetimes we should see a 5 standard deviation increase. So under this, it would be incredibly rare to see big moves. A 5 standard deviation in the market is about a 6.5 to 7-ish% one-day change. And so what do the numbers tell us on this? Well, the numbers tell us that we've gone over the 5 standard deviation mark 11 times since 2008, right? So something that should happen once every 7,000 years has happened 11 times in the last 12 years. There's always a joke about it's a once in a lifetime thing that happens about every 7 to 10 years. So this is part of what comes with the stock market. The numbers historically would tell us that these moments where we have very volatile periods are actually not that uncommon in the stock market. And it just is part of comes with the territory. So again, the point of this is, one, to give you a sense of this is kind of an extraordinary period, but also extraordinary periods are not as extraordinary as we think. The cause is often different. In 2008, we had a housing crisis and a credit crisis. It was really more of a financial event. This time we have a pandemic. And certainly it's been, since probably, 1917 or so since we've had something similar. But we tend to overly focus on the cause of these crises as we kind of plan for the future and under recognize the fact that we don't know what the next crisis will be, but we do know there will be a next crisis. So that should sort of dictate, I think, our narrative and how we look at the economy. So at this particular time in history, I think it's actually a great time to review basically any and all economic narratives that you have and that others profess. I think it's a good time to challenge very basic assumptions and the very most fundamental things about the way that we reason through economics. And that's basically what I'm going to do here. Is I'm going to give you my narrative. I'm going to start with the most fundamental parts of the economy and financial markets. And of course, we don't want to forget the numbers because we might have a story that sounds really good to us. and then the numbers just don't support our story at all. And we have to be kind of willing to give up our story when evidence doesn't agree with us. So in my narrative, cash is king, right? The star of the story, the character that makes this story go is cash. And so this happens at a couple of levels. It happens at the individual level. So our own cash reserves, our own ability to generate cash is the driver of our own economic narrative. How we feel about ourselves economically, financially, depends basically on the amount of cash that we have and our ability to generate more cash. And how likely we think we are to continue to generate cash and hopefully generate more cash at some point. And again, I mean, you can feel free to completely disagree with my story here. But in my story, this is the building block that I start from. And let me ask you a poll question here on cash. I'm just going to get you to take a guess on this question. So when I talk about non-retirement savings, I mean, you know, outside of things like IRAs and 401ks, how much savings do you think workers making between 75,000 and 100,000 had before the crisis? I'll give you a second to think about this. Checking the chat, I see a question on sharing the slide deck. I'm definitely good sharing the slide deck, and I can send that to Katie to distribute to participants. Glad to do that. Question on if whether or not savings includes equity in homes. I wouldn't include it in this. It would be like things that you'd have in pretty liquid investments, checking money market savings accounts, like really near cash and near cash kind of things. Good question. All right, I'm going to close this down and we'll take a look at where everybody's at. So, you know, about half the group in the 10,000 and up, and about half the group in the less than 10,000. A couple people in the less than 1,000. No one in the super high group. So basically, if cash is the star of this show and of this story, I think it's worth looking at some numbers on where people are at with respect to cash. And this is one of my favorite graphics ever. I reference it a lot. I've got a few former students joining us today, so they've heard this from me before, but Bloomberg did this analysis. And so the different color boxes refer to how much savings folks have, and that's broken down by income. And so my question asked you about 75 to 100,000 folks in that group. And if you see, the pink goes up to about and above the 60% mark. So over 60% of people making between 75 and 100,000 have less than $1,000 in savings. And of course, you can see that making more money usually means people have better savings. But also, you might be kind of amazed to go look at the 150,000 and up crowd. And so that black box about hits the middle of this. That's about 50% of people. So about half of folks making over 150,000 have less than $5,000 in non-retirement savings. So sort of easily accessible liquid cash savings, they don't have much. And so part of the reason why things like basically a stoppage of the economy and a stop of paychecks and sudden unemployment can be so disruptive to people, and it can cause a trickle down into the economy very, very quickly, is based on this. If you put all of this together, this is another often quoted statistic that I like, but well over half the country could not write a check for a $500 expense if they had something unexpected happen. This shock to people's incomes and maybe not corresponding to a shock in their expenses, at least not in the direction they want, is a recipe for major issues. So this is some data on where individuals are at. But, you know, I think my kind of advice, especially for early career folks, is now is a good time that if you didn't already take this particular issue seriously, now is a good time to get serious about this moving forward. I mean, we all kind of are in whatever situation we are at this point. We're just going to move forward as best we can. But, you know, I finished undergrad 2 years before the financial crisis. So I was a young alumni in a previous crisis. And one of the things that definitely got my attention, especially being a finance person and a lot of my friends working in finance, is banks were hit very hard early on in the crisis. And so a lot of my classmates and friends that were alumni from my own undergrad found themselves laid off very shortly after graduation, or hitting the job market at kind of a tough time. And that definitely made an impression on our generation in terms of it wasn't an abstract thing. It was concrete to us that that things could happen. Now that doesn't mean that we necessarily remember those lessons until this crisis. Good question on why these numbers are so low, and why I think they might be so low. And the answer is really kind of it tees me up for my next conversation, which there's two things I want to talk about: a budget and a balance sheet. And so one thing that is amazing, and I've done a lot of finance talks and personal finance talks for a lot of different people, and a lot of times we think folks that make a lot of money or are well educated just kind of like know what to do with personal finance. I've not found that assumption is on average true. Certainly, a lot of people do manage their money well, but personal finance is not really something that we're ever taught. It's something that we maybe picked up from our families or maybe mentors or others. And honestly, I mean, for many of us, maybe we picked up not good lessons from examples that we had growing up. And so there are two very simple things I'd highly recommend. And to answer the question about why savings are so low, the answer is, even though people who are aware of these two concepts will say they do this kind of thing, most people don't actually do this kind of thing. And this actually is something I do personally. So this isn't, I certainly don't think I'm beyond doing this kind of thing because I like teach finance. Like there's no way to think your way around these types of things. You just have to do it. And so first of all, it's a budget, which is simply just track the amount of money you have coming in, track the amount of money you have coming out to the dollar. I mean, you want to know exactly, you know, in a typical month, most people like to budget on a monthly basis. I'm a fan of that. But know on a typical month, how much money do you have coming in? How much money do you have going out? And then if you're not making more than you spend, you've got an issue. And long term, that's not sustainable. And so you need to set yourself up so that your typical month creates a surplus and allows you to build savings and allows you to not be in that under 1,000 savings group, but to be in the relatively safer crowd. And, you know, just kind of a back of the envelope thing is folks suggest that you should have about 6 months of your income in a rainy day fund. And so when people are, especially young alumni, early career folks ask me, what's the first thing I should do financially? I always say, build a rainy day fund. Before you worry even about, you know, investing and all this other stuff, just take bad outcomes off the table is my first bit of advice. And the best way to do it is to create a budget make sure you set aside enough that you can build that up. Now, I made the interesting financial choice to get a PhD. So I was in school until my official, like, done with school, starting the working world came at a later age than maybe it did for some of you. So I didn't have any income for quite some time, and it took a while to build. So you shouldn't necessarily feel bad if you haven't built that, but that's a good goal to have. And then the other thing that I highly recommend is a balance sheet. And you're just going to list what you own and what you owe, and then track this over time. You don't need to do this as often. I would do this more like once a year. I have a video on this. The Block School, we have this idea bar where we've been kind of sharing ideas on topics that relate to the crisis. And this was a video I put together, and we'll get you the slide deck and you can check this out. If you Google Block Idea Bar, you can also find my posts on there and see this, but I've got a longer explanation. But this gives you your net worth. This gives you a better idea of kind of longer term assets and longer term liabilities where you're at. So it's good to run a surplus month to month, but sometimes our money in our budget is going towards good things. It's going towards assets, to investments, to houses, which could increase in value. And then, also, is your money going to liabilities, to bad things? Do we have bad debt? Do we need to rein in our debt? Which debts are the ones that we should be paying off first? Those types of things, this analysis can help you figure that out. Good question on what I use to track my own budget. A lot of cool software out there, and a lot of different ways to do this. Honestly, one thing that I do that I find very helpful is all of my expenses come out through a single checking account. So I have multiple other bank accounts, but I have a single checking account, which means I can basically use my monthly statement, which I can also download to Excel, and I have my cash outflows, and I can easily get that for an extended period of time. Now the issue is, like, I have I pay my full balance of my credit card every month for full disclosure, but that would just hit my checking account once. So then I would go into my credit cards, and then you would, if you wanted to drill down in more detail. But most major credit cards have some pretty cool, downloadable stuff, and even some analytics you can do on grouping your spending there. Or you can be very, very low tech. I mean, honestly, it's not all bad just to maybe not even at first drill down too much, but just get big numbers of what did I have going out last month, what did I have coming in, and track that, and then get more specific over time. So it doesn't have to be high tech, and I don't use anything other than what financial institutions I already use have available to me there. But very good question there. So if I widen the lens, though, from individuals to companies, does my cash is king story still hold? Well, this goes back to 1990, and this has the S&P earnings per share plotted against the price of the S&P index. So how did the stock market price level vary with the amount of earnings? And it almost doesn't even matter which line is which, right? The orange line here is earnings. Brandon noting that Excel coming out with an expense tracking plugin. That does sound cool. Definitely check that out when that comes. This orange line is the earnings, and the blue line is the S&P. But you see, they get away from each other a little bit at times. But actually, if you look, like, after 2015 until very recently, they were tracking really, 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 really closely together. And so there is some evidence that cash is king. Firms' ability to generate cash also dictates their price. And if you want to expand that more generally, I've added this blue line at the top, which is the GDP. So this is just, how does the economy do? Is the economy producing more? And this goes back a long time. This goes back to the 1800s. And you can see that over a very long period, the trajectory is pretty similar between the country's ability to produce stuff that gets sold, and the stock market. So, you know, why does this matter? Again, trying to make sense of everything that's going on. If we produce less stuff as a country, if we earn less at the firm level, if we're earning less as individuals, then the stock price will react accordingly. And that's part of the reason you see so much volatility in the market, is we're trying to figure out just how much reduction to GDP, to earnings personally and at the firm level that we see. Good question from Michael on what to do if you have more variable incomes. And so a lot of folks have variable incomes for a variety of reasons, maybe because of seasonal work or maybe commission-based work or a variety of other causes. And it's a great question. And honestly, it's one of the difficult things about having those kind of professions, is because expenses tend to be at the personal level relatively constant throughout the year. They're not super seasonal, but yet our income might be a little more seasonal. And so I do think, you know, maybe the month-to-month thing makes a little less sense, other than I do think you definitely need to know how much money you've got going out every month, so that you know how many months you can kind of get by with a lower income level. And that's, of course, one of the things that's a little bit scary about commission-based compensation is you could go you don't necessarily know how long you could go before hitting a bump in income. So for those folks, I would recommend a little more cushion in the safety net as a precaution. So definitely great questions, by the way. Appreciate everybody chiming in with these. So if cash is the star, then as we see the plot kind of develop, what's the kind of like, what's the point of the plot? Like, what's driving the plot? And I've got this Buffett quote here that I really like, which says, price is what you pay and value is what you get. And the idea here is that one thing that's been really confusing, there was a meme from Kramer on Mad Money that went viral because it had the headline scrolling across the bottom about unemployment being record levels and the market was up big. And some people making you know, even moral judgments on this, which I'm not here to talk about anything like that. But even economically, people are like, how can this be that when you have this massive unemployment spike, you also have the market doing well? And part of it is value is driven by a firm's ability to generate cash over the long haul, just like our economic value is driven by our ability to generate cash over the long haul. And so stocks are forward-looking, and they tend to lead the economy. So they're not based on what has happened, they're based on what's going to happen. And so I'm not saying the market's right to be going up, by the way, but what I'm saying is it tells us when the market goes up that the market's optimistic about what they're seeing in our ability to get back to work safely. And again, that may be inaccurate. But I want to ask you the final poll question and ask you to kind of look forward a little bit here. And out of these options, which do you think is best positioned to be doing well in the next 10 years? I'll give you a chance to think about this for a second. All right. Go ahead and submit your answer if you haven't. I've got all but one submitted here. Close that off and I'll share it with you. So Amazon the winner, but Amazon won the market. Carnival Cruise got 1 vote. Exxon got no vote. And of course, again, the reason we need narratives to make sense of financial markets and the economy is because it's not a concrete topic. This is not a hard science. It's not like rigidly formulaic. We don't kind of get to go into a lab and study it. It's messy, it's uncertain, And so, of course, any of these guesses could prove to be, good investments or bad investments. We don't really know now, but that's why I'm asking you just to do your best, because that is what we have to do. But let me show you some numbers to support this, and give you another example of what I was just talking about, my narrative about how the market works and value and price. And I wrote this blog article in kind of at the absolute peak of market volatility and discord, and we were in absolute free fall in the market at this point on the 19th. And I wrote this for our idea bar that we've got at the block school, which is, basically the rest of the article was the bad news, and then there was the silver lining that Amazon's hiring a bunch of people. And then I said, this provides an example of a fact the market seemed not particularly interested in for the last 2 weeks, which is not all firms are impacted the same by this event. And so what were the numbers I used to support this? And are there any numbers to support that your estimate that Amazon and the market are overall better positioned than these other companies? Is there any support for that, or are we just kind of dreaming here? Well, you can see the kind of grid at top, but the dark blue is the market, the light blue is Amazon, the purple is Carnival Cruise, and then the pink is ExxonMobil. So again, I wrote that article on about the 29th or the 19th, of March. If you just track the trend in stocks, they were all moving basically at the exact same slope over that period. And that's when I made the observation that everything was just moving together, and the market was behaving as if all of these companies were going to face the exact same future. And that went on for weeks, really. And about the time that, and I'm not taking credit for this, by the way, that I pointed it out and the market figured it out. The market was starting to figure it out already as early as maybe the 14th or 15th, a little bit. But since then, Amazon actually, so this goes back to Valentine's Day, Amazon's net up since before this crisis. And so the market very much agrees with this group's polling numbers, which would say that Amazon is the best suited. And coming in second is the market, which was the option that came in second for this particular group. Exxon not doing nearly as well, but doing better than Carnival Cruises. And this data is just slightly old. And of course, since then, oil prices went negative. So certainly, I think that might contribute to many of you not considering Exxon as your option for who's likely to do best. But again, what's the point of this? That you want to be kind of clear about the story of the economic impacts of something like this crisis, and realize it's not just a universal blanket impact. It's more nuanced and complicated than that. And I think, as a group, the poll indicates you guys already get this this issue, but just giving you an idea of how to come up with numbers to support your hunches, which in this case were pretty spot on, and also just kind of how you can interpret market moves. We're not done with volatile market moves, because we'll have more bad news, we'll have more good news, and you'll see big swings up and down for the foreseeable future. And hopefully this conversation helps you make some sense out of those moves and plan a little bit as far as what's going forward. Well, it wouldn't be a very good story without a villain. And the villain here is unique, but every story, every adventure story like this has a villain. So if it's not this, there will be other villains at other times in our lives economically. And so if you think about economically, where does the pain from the shutdown show up probably the most? And that would be unemployment, would be the biggest hit. So first of all, though, what I want to point out is this is unemployment going back a long time, into the 50s. And you can see that there's a lot of these rapid increases in unemployment. And what has happened historically in this country, this would look the same if you went back even to the 20s, by the way, is things will kind of go along reasonably well, and then they go really badly really quickly. And I mentioned this earlier, but I think the only group probably likely to do anything meaningful to fix this in the future would be folks here as younger alumni, is because the past groups have basically shown we're not very good at learning this lesson. And so, you know, in 2008, we had the financial crisis and there was legislation, banks are better capitalized, people really thought more about the housing market and they challenged that narrative, and we really focused on that issue. But what we didn't focus on is we don't know what the next crisis will be. You know, most people weren't predicting this particular crisis 6 months ago, a year ago, 2 years ago, certainly. And that's the way these things tend to happen. And so a lesson here is that when employment hits, it hits quickly. And one phrase that a lot of policymakers are fond of saying right now is, you know, it's kind of the folks that are losing their jobs, it's not their fault. And what I point out is on any of these spikes, the number of people losing their jobs due to their own fault would be incredibly low, right? So like any bad time, that basically describes that situation, which means you could be very good employees, you could be doing very well at your firm could be doing very well, but you could find yourself pivoting out of that position quickly at any time, which goes back to the emergency savings and thinking there. So I think there's some good news to being early in your career. Everyone was in the hold or buy mode, so no one, I don't really even need to make this point, I don't think. Everyone seems to get this, that you've got time to recover what you have saved for retirement. You might even be able to buy things a little bit cheap. You probably have relatively more career flexibility than someone who's 30, 40 years into a career that might have a hard time pivoting out of an industry that's going to maybe be permanently or semi-permanently impacted. And I do think an advantage to being earlier careers, on average, folks earlier in their career are a little more open-minded to quickly adapting to new norms and new ways of doing things, because you're not super invested in the status quo way of doing things. And so I think you could take advantage of that in this particular situation. The bad news is the split on the age groups probably doesn't fully capture it, but you can see here, you know, in this 20 to 24 range, like the next grouping is like the 25 to like 45 range. And so that gets a little bit too wide for a young alumni group. And most of you probably pushing or out of this, this demographic, but much, much higher unemployment for earlier career folks, and generally more likely to get dinged by layoffs and the like in these types of times. So there is I think some disadvantage here. And so it wouldn't be a very good story if I didn't have a great ending, except for I tried to set the bar low up front. I don't have a great ending. I'd love to look into my crystal ball and tell you what exactly is going to happen and give you a way to plan on that. But I don't have that. But what I would be interested in is hearing from all of you. And if you want to chime in on chat or raise your hand to be unmuted on any of these questions or other questions, I really wanted to open up the remainder of this time to just kind of have a conversation with you all. Great question on inflation impact of government stimulus. And in my undergraduate class, I let them pick a certain number of topics that we could cover. I like rip from the headlines. And this was one that they picked as well. And so I posted an article. There've been a lot of articles written on this, but you could obviously find those if you wanted. But I'll give you my opinion. Which is, I think it's very likely to be minimal. The the first, I got to UMKC in 2011, so we were still in response to the crisis mode. And that was a hot topic then, of all this quantitative easing and stimulus and everything else was going to cause rampant inflation. And of course, that didn't happen in that particular case. And we had a dean at the time who really wasn't an economics person, but he was at an economic meeting with me, and people were worried about the dollar. And, you know, we're going to devalue the dollar and there's going to be inflation. And his point was, if everyone in the world is doing stimulus, you know, currencies are always relative and prices are kind of potentially relative in the same way as you think about buying stuff from other countries and imports and exports. And basically, if everyone is kind of moving in the same direction, then that neutralizes things. And the other thing I'd say about stimulus is, if you did a stimulus of this magnitude during a normal period, you'd probably get inflation. But if you do stimulus just to replace basically income that people would have had otherwise, then you just get consumption that people would have had otherwise, if that makes sense. You're not getting extra consumption. You're getting extra consumption compared to if there was no stimulus, certainly, but not compared to like what we would have had if economic times were going as normal. So I'm not super worried about inflation. Also because I think demand is going to still be suppressed even with all this stimulus for a while. But I think it's a great question, and taxes going forward is a great question. So the article I'm having my students read, it has a very different view on this that I do. It's very negative. It thinks we're going to see inflation, and it also points out that the younger generation is going to be the one paying for all of this over time through, you know, massive government debts and that sort of thing. And certainly there are a lot of folks who feel that way. It's quite cheap to borrow right now. People remain interested in buying U.S. debt, but I think it's fair to ask that question, certainly, of how that could impact things. Brandon asking a chance to make money on negative oil prices without taking physical receipt of oil. It's a good question. Trading oil can be a difficult thing, and I would not recommend it if you don't have some familiarity with it. As many people have discovered, is they didn't necessarily know exactly what they necessarily were trading. Actually, my broker is Interactive Brokers, and they just sent out a memo saying they're going to take a $77 million loss because of traders they had who didn't have their oil positions fully covered because they didn't ever anticipate negative oil prices. And so when pros and brokerages are getting caught off guard, I mean, if you can figure out a way, there may be a way. I've been seeing on TikTok, I saw somebody measuring their van to see how many barrels of oil they could fit in there. So maybe that's your solution. I'm kidding, by the way, on that. Insight on the housing market in the next year or two. Actually, it's a really fantastic question, and it is one of my big questions. I've invested in real estate in single family housing before. I'm not in that market right now. And I think the answer to that will really depend on, to me, the big question, and it's the question that I kind of have for the very last one, is it depends on how much of what we're seeing is short term and how much of what we're seeing is long term. And then the follow on would be, if to the extent that you know, an extreme slowing of the economy is a more longer term situation, then will there be additional stimulus to offset that? And will there be additional plans to cover that? But to give you more, just like a scenario, is if this ends up being longer term and unemployment continues to spike, which I think it will, by the way, in the short run for sure. We haven't seen the worst of unemployment yet, would be my prediction. Then you're going to feel some housing pain. And maybe people can limp along with mortgage payments for a certain amount of time, and banks are being a little more lenient than maybe they were in 08. And so maybe that limping period is 6 months. I don't know. I don't know what the number is, but there's a breaking point, I think, at which you're going to have negative outcomes in the housing market, which could could certainly influence things. Another, counter to this though, is a lot of people are slowing building and stopping new projects. And so if the bounce back from this crisis is fairly quick, if we're back to normal fairly quick, and you combine that with a certain period of, a lack of new housing being built, maybe there'll actually be some pressure on housing prices and they'll go up. So it's a good way of not answering your question. Like I said, I try to set the bar very low. If I definitively knew these answers, I would just be ringing the cash register and just cashing in on all these things. So a lot of folks probably getting ready to get back to work here. One person checking in here. So let me just wrap up with some kind of closing thoughts. This is the closest to a conclusion I do have that I can say definitively. Is it's better to prepare than it is to repair. Meaning it's better to have that safety net, both at the individual and at the firm level, than it is to wait for bad things to happen and then try to patch everything together. And that's what I was encouraging all of you to think about more system-wide, because previous generations have not really developed great mechanisms for this. As you can tell, we're basically just winging it right now, and I include myself in that group. I also think that those who are able to change and adapt are going to win, and I think that could be some of you. I also think that we can get overly worried about predicting exactly what's going to happen. It's better just to pay attention to what's going on right now, and really be clear about the pain points at this given moment, because we really don't know exactly what's going to happen. And then just keep learning. I mean, you're at the stage of your career where that's probably a wise strategy even in normal times, but you never know when you're going to need to pivot, or you might spot an opportunity. Just keep your eyes open and keep learning. But I hope, collectively, this conversation was useful to you, and I enjoyed getting to hear from you, and thank you all for coming and for joining us.
Thank you all for your time today.